Over the past 10 years, London house prices have barely moved, at least on the surface, because when we take into consideration inflation, well, the real picture is very different. So what exactly has happened with London house prices? Well, in this video, I want to break down why London house prices appear to be stuck, why we've had a rental boom in recent years, but also whether we're finally seeing a shift for landlords here in the capital. Stay tuned. I'm going to share with you a typical story of property investors. Meet Harry and his wife, who were deciding where to make a long-term property investment, and they looked across the UK. Now, they were both born and raised here in London. They knew the streets, they were familiar with the communities, and had a pulse of the city. And ultimately, it was between London and the north where they can get much more for the money. They decided to stay in London and make the investment here. At the time, two things stood out to them. Firstly, London house prices were rising faster than anywhere else in the UK. So it felt like they were stepping in the fast lane. Because in comparison to the north, well, things weren't quite the same. And there's always been this divide between southeast and the north. Now, secondly, is that they felt that if they didn't buy then, they will never be able to afford to buy in a city like London. And they were absolutely right. 15 years later, and London has the most expensive homes across the UK by far. But here's what you rarely hear. London house prices have stagnated for years. So looking at the past decade alone, London house prices have risen by just 13%. And when we adjust this for inflation, this actually represents a 16% drop in real terms. That means that for an average home today in London, you can get almost 2.5 properties in the northwest. Now, back in 2016, this would have gotten you at least 3.5 homes in the same area in the northwest. And yet demand in the capital is surging, with the London population hitting a record high of 8.95 million in 2023. After a slump after COVID. The UK's population continues to increase, and the truth is that London continues to absorb much of this population. And the numbers were revised upwards, and I'm sure that after a few months, based on the research that we've done, this number has increased. So with more people than ever, why is the sales market so quiet? Well, let's take a look how we got here. So in the 1990s in London, the property market was very unstable. Now, this was at the back of the decade starting with economic chaos after a crash in the 80s. Now, there was economic uncertainty, unemployment was very high, and property prices were low. Government efforts failed to stabilize the market, and house prices continued to plummet, hitting a low around 1995, especially when it came to London and the southeast. This period significantly impacted affordability. Property prices surged far ahead of income growth, and home ownership rates, well, they began to decline. And by 2001, fewer Londoners owned homes. At the same time, major developments like Canary Wharf began transforming the property landscape, with huge leaps in value driven by significant investment and regeneration. In the early 2000s, or the golden 2000s, house prices kept on rising. This was due to easy access to mortgage, but also strong demand kept on pushing prices and values upwards. But then came 2007, the global crisis, and of course we saw a crash in 2008. Lenders tightened their lending policy. It's crazy to remember that back then you can present 3 months pay slips and some other paperwork, and that would be it. You will be granted a mortgage. Since then, of course, mortgage has become much harder to get, and as the consequence at the time, we saw a 20% drop in house prices. The impact was serious. A lot of people lost their jobs, the economy slowed down, and a lot of people ended up in negative equity, meaning that the cost or the value of their property was less than their mortgage, and they couldn't sell or move. After the crash, foreign investors started pouring in and buying properties in central London areas like Chelsea, Kensington, and Belgravia. And prices quickly started to increase again. And not only in London, because what happens is you have that ripple effect, and it started to go other parts of London and outside of the city as well across the UK. But over the past 8 years, that growth has slowed down, even completely stopped in some places. The reality is that London market has stagnated, and especially when we look at those prime London neighborhoods. And this is because of a mix of tax changes, tighter rules, but also affordability issues. And higher interest rates have made things worse, especially in London where property prices are so much higher, which means that mortgages also are higher. And this affordability issue does feed into the market and make the market slower, and especially where sellers don't want to reduce their prices. And yet all of this didn't happen overnight. In 2014, stamp duty changes meant that higher priced homes were much more expensive to buy. And of course, we also had in 2016 the stamp duty surcharge for second homes. This was especially targeted for buy-to-let investors. Now, at the time, government said that they wanted to level up the playing field between buy-to-let investors and just home owners. And then, of course, we also had the implementation of Section 24, which practically meant that landlords were now being taxed not only on their profit, but on their turnover. Introduced by the then Chancellor George Osborne, announced I think it was around 2016. Now, if you're not familiar with this was the removal of the ability for landlords to deduct their tax from the interest that they paid on their mortgage. Now, the best way I can explain this is by way of a typical story of Michael, a professional landlord, which I actually found online. So, let's say that Michael was earning £110,000 per year from rental income and paying £27,000 on mortgage interest. Now, from the phasing of 2017 to 2020, which I believe was 25%, this could have had a huge impact on Michael and what he was left in his pocket. And this wasn't just a unique story. A lot of landlords were hit with this, of course, after 2020, because a lot of landlords had their properties on their personal name. The difference would be someone having a company, a limited company, whereby they continue to do that. And this naturally pushed a lot of landlords into a higher tax bracket, even if they were just breaking even or even perhaps even making a loss on their property portfolio. All of this has made property investment less appealing, especially in those areas where rental returns were already low and the capital growth was the main attraction. The reality is that landlords right now, well, they have been squeezed, but it's just not landlords who have been affected. First-time buyers also face some challenges in the capital. In fact, tougher mortgage rules. At the moment, they need more than 4.5 times of their salary. We're told that you need, on average in London, over £140,000 for a deposit according to UK Finance. And that's one reason why the number of first-time buyers in London really never fully recovered after 2014, whilst other parts of the country saw a bounce back after the pandemic. And of course, with mortgages being as high as they are right now, well, that has contributed as well to the market stagnating. At first, it may seem that flat prices would help, because if prices stop increasing, then maybe income can catch up and property will become more affordable. But there's a downside. More people are moving to London and fewer people are buying. And those who do manage to buy quite often struggle to build any type of equity and are stuck with properties that no longer meet their needs. Others are dealing with issues like cladding or even struggling to sell properties in shared ownership, which is a whole different problem to deal with. When fewer properties are bought and sold, it causes problems in the housing market. People can't move for jobs easily, the government collects less taxes, and developers build less. Many recent developments have been aimed at buy-to-let landlords and first-time buyers, but even those big build-to-rent investors haven't been able to build at the same levels as previous. In fact, in 2023 to 2024, London only added 32,162 new homes to its housing supply. That's the lowest number since 2014 and 2015. Efforts to boost market haven't worked so far. New mortgage products with longer terms or bigger income allowances could help some buyers, but they're still hard to access. The mortgage rates price war is over. And as for government action, well, we're still waiting. The delayed spending review has left questions over how the government plans to fund the property that the UK needs. Where does that leave us? Well, it leaves us with a city full of people, fewer buyers, and a housing market that feels stuck. But despite the flat house prices, London has just been named the fastest growing buy-to-let market in the UK, at the start of what could be a major year for the rental market. Simply Business has analysed over 100,000 policies to find out which areas have the most activity when it comes to landlords. And the results are clear. Between 2023 and 2024, London saw an increase, a rise of 13% new buy-to-let landlords entered the market. This is triple the growth seen the year before. And this is contributed based on the strong rental demand, but also the variety of properties that the capital offers. And by contrast, Glasgow, which was at the top of the list, is now at the bottom with just 7% growth. An experienced landlord like Mike Harvey are reaping the benefits. He's been investing in London for over 25 years and says London is a good place, saying it's easy to find good tenants, rents are strong, and insurance are competitive. I also have reliable tradespeople on hand whenever I need them. Our 2-unit block has been low hassle with great tenants and strong returns. It's a great long-term position. London is home to the largest number of landlords who own multiple properties, followed by Manchester, Birmingham, and Nottingham. And this group is going to have a critical role in the property market throughout 2025. But it's not all good news, because rising costs and of course regulation is having an influence on how landlords think. Simply Business 2024 landlord report, based on nearly 2,000 responses, revealed that 71% of landlords believe the next government will harm the buy-to-let market, and 69% said constantly changing legislation is their biggest headache. And if you really want to find out why landlords are leaving London, make sure you watch my next video, Impact Reviewed. So where do we stand? Well, a decade of slow price growth, a surge in rents, more rules than ever, but also a surprising recovery with London buy-to-let market growing again. Now, the question just isn't whether prices are going to grow, but also whether this slow period is the turning point.